Hello everyone, I am Akash Arak and today we are going to explore some key terminologies used in hedge funds. Now, hedge funds might sound complicated, but my goal is to explain them in very simple terms so everyone can understand. So, hedge fund use various strategies and techniques to maximize profits, and there are a few common terms that come up often in discussions. By the end of this presentation, you will feel more comfortable with these terms and understand how they impact the hedge fund world. We will cover concepts like asset under management, long and short positions, leverage, some important fees, and about hurdle rate and high water mark. So let's dive in. So let's start with the basics. What exactly is a hedge fund? So definition says a hedge fund is a pooled investment fund. What that means? It means that it is a fund where many investors, often wealthy individuals or institutions, put their money together. The goal is to use that pooled money to generate higher returns. So now imagine a hedge fund as a sort of exclusive investment club. Typically, only people or companies with a lot of money can join. These funds have access to more flexible and sometimes risky strategies that a regular mutual fund can't use. Why? Well, hedge funds are allowed to use aggressive techniques like borrowing money or making bets that stock will fall. Sometimes they can help them make money even when the market is going down. So in short, hedge fund focus on making big profits by being very strategic, often using methods that carry more risk than what we might see in other types of investments. Next up, let's talk about asset under management or AUM for short. The definition says AUM refers to the total value of all the money that a hedge fund is managing on behalf of its clients. Essentially, it's the sum of the cash, stocks, bonds, and other investments that the hedge fund controls. So, here the key point is think of an AUM like the total worth of everything a hedge fund has under its control. If you had a giant piggy bank, AUM will be the value of everything inside that piggy bank. The bigger the AUM, the bigger the hedge fund. So, a fund with $10 billion in AUM is managing a lot more money than a fund with $100 million. Hedge funds with large AUM usually have more resources and opportunity to take on bigger investments. So, if I summarize, AUM is a measure of the size and influence of a hedge fund. It tells us how much money they are responsible for managing. Now, let's dive into two key terms that are often used in hedge funds: long and short positions. Long positions. First, we have a long position. So, this is the most common type of investment. It means you are buying a stock because you believe its price will go up in the future. Think it of as you placing a bet that the value of something is going to rise. Short position. Now, a short position is a bit more complicated but can be very powerful. Here, you are doing the opposite. You are borrowing a stock, selling it immediately at the current price, and hoping the price drops. Then you buy it back at the lower price and return the borrowed stock, keeping the difference as profit. In simple terms, you are betting that the value of something will go down. So let me give you one example to make it easier. Think of it like betting on a horse race. If you bet that a horse will win. That's like taking a long position. You are expecting the horse or stock to do well. On the other hand, if you bet that the horse will lose, that's like taking a short position. You are expecting it to perform poorly and you win if it does. If I summarize, so in short, long position bet on prices going up and short positions bet on prices going down. Hedge fund use both strategies to make money in different market conditions. Let's move on to leverage, another important tool used by hedge funds. So definition says leverage is when a hedge fund borrows money to invest more than they actually have. This allows them to increase the size of their investments, which could lead to bigger profits. So if I talk in key points, so an easy way to think about leverage is like taking out a loan to buy a house. You borrow money from the bank, buy the house, and hope that its value increases over time. When you sell it for more than what you bought it for, you make a profit. In the same way, hedge fund borrows money to invest in stocks, bond, or other assets, hoping that their value goes up so they can make a bigger return than they would have with just their own money. So important notice, uh, but there is a catch. While leverage can lead to bigger profit, it can also lead to bigger losses if the investment don't go as planned and the value drops. The hedge fund still has to pay back the borrowed money, which can make the losses even worse. So if I summarize, leverage is a high risk, high reward strategy. It can help a hedge fund make a lot of money when things go well, but it can also magnify losses when things go wrong. Now, let's talk about the different strategies hedge funds focus used to make money. Hedge funds don't just invest in stocks and wait. They use a variety of techniques to try and stay ahead of the market. So some common strategies are: number one is arbitrage. This is when a hedge fund looks for small price difference between markets to make a profit. I give you a simple example. If a stock is trading at one price on the New York stock exchange and a slightly different price in London stock exchange, they might buy in one place and sell high in the other, making a small but fast profit. The another strategy they use is global macro. Here, hedge fund bet on large economic trends. They might make prediction about things like currency value, oil prices, or interest rates based on what's happening in the world economy. Example, if they think oil prices are going to rise due to geopolitical events, they might invest heavily in oil related stocks. Third strategy is event driven. This strategy focuses on events like company mergers, acquisitions, or bankruptcies. Hedge funds look at these events to see if they can profit from changes in a company's stock price. For example, if two companies announces they are merging, the hedge fund might buy shares betting that the merger will drive the stock price higher. Simple example I will give you. Think of these strategies like using different tricks in a game. Just like in sports or video game where you might use different moves or tactics to win in different situations. Hedge funds switch up their strategies depending upon what's happening in the market. So if I summarize this, Hedge funds are constantly adapting using this and other strategies to try and outsmart the market and make profits for their investors. Now let's talk about how hedge funds get paid. There are two main types of fees that investors pay when they invest in a hedge fund: the management fees and the performance fees. Management fees is also called as sub-advisory fees, and performance fees is also called as incentive fees. Management fees. First is the management fees. This is a fixed fee that hedge fund charge simply for managing your money. Whether the hedge fund makes a profit or not, they still collect this fee. It's usually around 2% of the total money you have invested. So think it of like paying a coach a base salary to manage the team, regardless of how the team performs. Performance fees. Now, the performance fees is where hedge funds make the bulk of their money. This fee is only charged when the hedge fund makes a profit. It's typically around 20% of the profits they earn for you. So, if they make a lot of money, they take a cut of that success. It's like paying the coach a bonus only when the team wins. Example: if you invest $1 million and the hedge funds grow it to $1.2 million, the performance fees would be 20% of the $2 lakh profit. That means the hedge fund keeps $40,000 and get the rest. So if I summarize this, hedge fund charge a fixed management fee for managing your money and a performance fees if they succeed in growing your investment. These fees can be high, but investors are willing to pay for the potential of large returns. Now let's talk about the hurdle rate, which is an important concept when it comes to how hedge funds charge performance fees. So definition says the hurdle rate is the minimum return that a hedge fund must generate for its investor before it can start charging a performance fee. It's like a target that the fund needs to pass before earning any bonus. So here the key point is, think of the hurdle rate as a goal post. The hedge fund has to cross that goal post to start collecting performance fees. If the hedge fund's return is below the hurdle rate, they don't get to charge any extra fees even if they made some profit. Let me give you an example. Let's say the hurdle rate is set at 5%. If the hedge fund generates a return of 4%, no performance fees can be charged. But if the return is 6%, the hedge fund can charge a performance fee based on the profits above the 5% hurdle. So they only earn their bonus when they deliver solid returns above the hurdle rate. So if I summarize hurdle rate, the hurdle rate protects investors by making sure the hedge fund only charges performance fees when they do better than a set minimum return. It ensures the fund is working hard to provide value before taking any extra fees. Finally, let's discuss the high water mark, another key concept in hedge fund performance fees. Definition says the high water mark is the highest value that a hedge fund has ever reached for your investment. The fund must exceed this value before it can charge new performance fees. This ensures that investors are not penalized for market fluctuations. So key points. One of the main benefit of having a high watermark is that it prevents investors from paying performance fee on the same profit more than once. For example, if the fund has a great year and your investment grows significantly, the hedge fund can charge a performance fees, but if the investment later drops in value, the fund must recover above that previous high before they can take any new fees. Example, let's say your investment was 1 lakh dollar and then it drops to $80,000 due to market changes. The hedge fund cannot charge the performance fees again until your investment value rises above that original 1 lakh dollar high water mark. So they need to work hard to get back to their peak before earning any performance fees on new profits. Summary. So in summary, the high watermark protect investors by ensuring they only pay performance fees on true gains above the highest value their investment has reached, preventing double dipping into profits. Now we have reached to the conclusion of this presentation. To wrap up things, we have covered some important terminologies related to hedge funds, including what a hedge fund is, key strategy they employ, and how they charge fees. And here's a quick recap of what we learned. So, one by one, we will cover it. Hedge funds, they are the pooled investment funds that aim for higher returns using various strategies. Then we have seen asset under management, also called as AUM, indicates the total money a hedge fund manages. Third point which we have learned, that is long and short positions. So these are the strategies to profit from rising and falling stock prices. Then we learned about leveraging. Leverage allow hedge fund to borrow money for larger investments, which can lead to higher returns as well as higher losses. Then we learned about some common strategies that which include arbitrage, global macro, and event-driven approaches. Then we learned some concept of fees. So hedge fund earn by two fees, usually that is management fees and performance fees. So performance fees is given when they exceeds the high water mark and the hurdle rate. Then we learned about what a hurdle rate. So hurdle rate is set a minimum return before performance fees apply. Then we learned about high water marks. So high water mark protect investors by ensuring fees are only charged on new profits. I hope this presentation has helped demystify some of the terms associated with hedge funds and given you a better understanding of how they operate. Thank you for your attention. If you have any questions or want to discuss any of these concepts further, I'm happy to help. Thank you so much for your precious time. Have a wonderful day ahead.